Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of January 13th. If you're new here, we're glad you found us. And if you're a regular, thanks for coming back. As always, we create these videos so that I can use my background in economics to help you better understand the economy and the financial markets so you can make informed decisions. So with that said, let's get ready to hit the books and get up to speed on the markets. Jumping right into last week. Last week was all about jobs. Earlier in the week, we saw some continuing evidence for the low hire, low fire condition of the job market, with the job openings and labor turnover survey demonstrating a reduction in hiring, but also a reduction in separations. At the same time, the November report demonstrated a significant increase in the number of job openings. The private payroll report from ADP also demonstrated 122,000 new jobs. So early in the week, the indication was that the job market was continuing to chug along at a nice steady pace. Definitely slower than 2023, but not necessarily faltering at the end of the year. The big surprise came on Friday. The National Employment Report from the Bureau of Labor Statistics demonstrated payrolls increased by 256,000 jobs in December, and the national unemployment rate dropped from 4.2 to 4.1%. This was actually about 100,000 jobs more than analysts had expected, and the drop in the unemployment rate was contrary to what most experts had expected to be a constant, stable 4.2%. So although the job market is undeniably tighter than it was at this point in 2023, it seems like we're coming out of 2024, possibly even on an upward trend, and maybe even in an improving environment. Looking at our consumer data from last week, we saw consumer sentiment fall just slightly, but we also saw big shifts within the consumer sentiment data towards inflation expectations. In general, we saw consumers' expectations for higher prices increase significantly 12 months from now, as well as over the long term in the next 5 to 10 years. On the consumer credit side, we actually saw a surprising drop in the amount of consumer credit, or the amount of money that consumers owe. Typically, consumer credit is divided into revolving credit, which most predominantly is credit cards, and non-revolving credit, which may include things more like personal loans or home loans. Although the total consumer credit dropped by 1.8%, the biggest shift was in revolving credit or credit card debt, which actually dropped about 12% in the month of December. We tend to watch consumers very closely because consumption in the U.S. economy typically makes up about 2/3 of economic activity. So when consumers stop spending money, that is typically a warning sign that the economy itself may be in for trouble. Last week, we also saw the minutes published for the December meeting of the Federal Reserve. In the minutes, we saw pretty clear indications of what the Fed chairperson, Jerome Powell, had mentioned during his press conference, specifically in the fact that members of the committee demonstrated a variety of concerns, but the predominant risk and the predominant concern about the future seemed to be the potential for a resurgent inflation. Switching over to the financial markets, last week we saw a shortened trading week as equity markets were closed on Thursday in recognition of the passing of former President Jimmy Carter. Despite the shortened week, we saw the stock market lose ground, with all three indexes losing at least 1% on the week. Growing concerns over inflation, tariffs, increasing 10-year Treasury yields, and the strong job reports, which suggest that there may be little to no interest rate cuts in 2025, all compounded together to lead to a more pessimistic outlook and a downward trend in the markets. Speaking of the 10-year Treasury yield, the yield on the 10-year Treasury increased from 4.6 at the beginning of the week to near 4.8 by the end of the week. We saw significant increases in the yield surrounding data released for the job market, especially on Friday, as the surprisingly strong employment report reinforced the fact that there may be less interest rate cuts and that the potential for inflation may be stronger than many investors and analysts had expected. As we watch the yield on the 10-year Treasury rise, one important threshold is the 5% point. Many analysts and economists believe that if the yield on the 10-year Treasury should reach 5%, that we will start to see investors shifting their focus as well as their investments out of the equity side of the market and into the fixed income side of the market as a way to capture these unusually high yields. This again remains one of the biggest short to medium term threats to the current bull market and the current condition of equities. One particular point of interest in the stock market last week was Nvidia CEO's comments regarding quantum computing. He indicated that it is his belief that realistic and practical application of quantum computing is probably 15 to 30 years out. In response to his comments, the quantum computing related shares or companies associated with quantum computing saw a significant sell-off, in some cases, shares dropping more than 40% by the end of the week. As quantum computing is a cutting-edge, highly speculative part of the market, it was interesting to watch the development, but not necessarily relevant to the majority of folks' investment opportunities. Wrapping up our look at the financial markets last week, we saw Bitcoin again dive downwards towards the $92,000 mark, but we also saw a variety of data indicating that there have been significant outflows of funds from Bitcoin and cryptocurrency-related ETFs. The big question is, where are these funds going? Are they moving into other cryptocurrencies, or are they coming out of the market temporarily until the Trump administration can get to work and potentially make forward progress? Or are these funds leaving the cryptocurrency sector entirely to move into other investments? And along those lines, we saw the markets and the prices for gold, crude oil, and the value of the US dollar all increase to a significant amount throughout the week. Looking ahead to the data for this week, one of the first reports we'll see is a report from the Department of the Treasury indicating the current levels of budget deficit and national debt. Given the ongoing conversation and discussion in Congress about the debt ceiling, the debt, and the implications of our current financial situation, this information will most likely serve as a good conversation starter, but without significant action or progress in Congress, it most likely won't have a significant effect on financial markets. Also, throughout this week, we'll see a large amount of inflation data being reported, including the Purchasing Price Index, the Consumer Price Index, and the Import-Export Price Indexes. As the fight with inflation continues, but recent data seems to have demonstrated a stall in that fight, this data will be incredibly important as we begin to establish our expectations and the trajectory or the trend for inflation in 2025. Also coming up this week, we'll see some information on consumers and business activity. Specifically, we'll see retail sales, business inventories, and capacity utilization within the economy. Wrapping up the information for this week, later in the week, we'll start to see earnings reports with a large portion of the powerhouses in the financial sector beginning their reports. We'll see earnings reports for the fourth quarter from companies like BlackRock, JP Morgan Chase, Bank of America, Wells Fargo, Morgan Stanley, and several more. In addition to the financial sector, we'll also see earnings reports from semiconductor giant TSMC and from the most talked about health insurance company in the United States, United Healthcare Group. Last of all, looking even further into the future, we are of course watching the upcoming presidential inauguration and the 100 days or first 100 days of the new administration, which tends to be a flurry of activity in both policy and legislative action. One of the most important pieces of legislative action we expect to see quickly is a discussion or a debate surrounding the debt ceiling. The debt ceiling itself will actually be reached in the middle of January, possibly even this week, but due to quote-unquote extraordinary action by the Department of Treasury, the estimation is that we should be able to continue to pay our bills as a country through June before needing to surpass the existing debt ceiling. Last of all, we're of course headed into the heart of fourth quarter earnings season. Next week, we should see about 50 of the S&P 500 companies reporting their earnings. The following week will be about 110 companies. The week of February 3rd will be at about 100 more companies. And the week of February 10th will give us about 60 more companies. So over the next 6 weeks, we expect to see a significant amount of discussion and possibly movement in the markets based on these most recent earnings reports. With all that said, I know it's a ton of information. I do want to just remind you that this is why we create these videos. In the future, there'll be a lot of data, a lot of policy, and a lot of changes. And what we're here to do is to bring all that information to you in a brief and easy to understand format so you can stay up to speed on the markets. I want to thank you for joining us. I want to encourage you to come back again next week and check out the next update. I also want to encourage you to take a minute to like and subscribe to this video and this channel and check out some of the other great content that we have below. With that said, thank you again for joining us. Have a great week, and I'll see you in the next video.